Good morning, everyone, and welcome to today's webinar. My name is Mike Kolodner, and I'm Marsh's U.S. Renewable Energy Practice Leader. I'm really excited. We've got a great presentation for you, a wonderful panel with some fantastic specialty colleagues here from across the depth and breadth of Marsh's energy, power, and renewables, as well as our property and cyber teams. I'm going to go ahead right now and just briefly introduce each of the speakers that we've got on the panel, and then I'm going to turn it over to our moderator who will go through some of the housekeeping items before getting started. First off, we have Monica Tigliano, who's one of our resident subject matter experts on cyber physical damage within the power and energy industry sector. Previously a senior underwriter at leading cyber markets, Monica advises clients on cyber physical damage placements. We've also got Caitlin Upchurch, who's our regional cyber practice leader and specializes in cyber insurance market. She develops manuscript forms for a variety of clients across industries, including energy, power, and renewables. Elizabeth Case is the cyber client engagement leader, overseeing advisory services for cyber and E&O risk throughout the United States. She's one of Marsh's key leaders on Marsh's global silent cyber operating group, and serves as the senior cyber and E&O advisor for some of Marsh's largest and most complex clients. Rob Albino is a senior property broker and a team leader in Marsh's energy, power, and renewables practice. Rob has significant experience managing complex domestic and global property programs for large national and multinational corporations. Sarah Baldes is the National Financial and Professional Liability Advisor or FinPro, for energy, power, and renewable clients focused on cyber risk issues. Toby Hudson joins us from the Emerging Risks Group, which identifies and quantifies complex risks that may pose threats to an organization's balance sheets. Toby addresses both insurable and non-insurable risks to enable strategic decisions at our clients' executive and board levels. And finally, I'd like to introduce Mike Gaudette, today's moderator. He's our national industry leader for energy, power, and renewables within Marsh's FinPro practice. Mike?
Thanks, Mike. Hello, everyone, and thanks for joining us today and for taking a break from the election news. We're going to discuss some evolving insurance challenges with respects to first-party cyber risk, and especially as it relates to physical damage. Now, while this challenge impacts all industries, we're really going to focus on energy, power, and renewables, and the recommended tactics and strategies that we're using in those sectors to secure the best insurance outcomes. Our panelists represent Marsh practice disciplines in property, cyber, energy, and power, as well as analytics. We're going to start with some historical context from the current insurance challenges, and then we're going to get right into the strategies that are noted here in the agenda. So first, a few housekeeping items. Feel free to ask questions anytime. Just click the Q&A button at the bottom of the Zoom menu to do so. We'll endeavor to answer all questions during the webinar, but if we don't get back to you live, we'll get back to you shortly afterwards. And then also, some of you sent questions in advance when you registered for the event. We're going to weave those into the discussion with our panelists. So let's begin with a quote from Albert Einstein. We cannot solve our problems with the same level of thinking that created them. Now, we all know that Einstein was not an insurance broker, but he clearly appreciated complicated problems. And while today's problem is not nearly as complex as the physical properties of matter, energy, space, and time, we would suggest that it does require a much more creative thought process than the thinking that went into the problem. Insurers have developed tools to underwrite cyber risk and have long been doing the same for property risk. The silent cyber problem has arose really at the intersection of these two products. So while the initial intent was for insurers to provide coverage clarity, the unfortunate outcome has led to significant coverage gaps, especially for our clients that buy large property towers needing a lot of capacity. Solving for those gaps is the theme of our discussion. So as we begin, let's take a poll to see what you're all experiencing. Our first poll question is, are you experiencing limitations to your property program related to cyber risk? So we appreciate anybody responding to this. Answer A to indicate that you are not seeing any limitations and have full coverage for ensuing physical loss. Answer B if you have affirmative coverage for the key perils of at least ensuing fire, explosion, or mechanical breakdown. Answer C if some of your insurers are excluding mechanical breakdown. D if some of your insurers are excluding malicious cyber. E if some are excluding all cyber via CL 380. And answer F if more than one of the above applies. So let's wait a minute to see what the results come in. Very interesting. So some of you actually do have full coverage for ensuing physical loss, 19% or seven responses. So that's very fortunate. We do see a trend in the other direction. And then 56% are saying that more than one of the above applies. That's really a very common situation with complicated property towers and a lot of capacity. That one of the key challenges is that there's a lot of inconsistency in those towers. And in some cases, you're seeing malicious cyber excluded. In some cases, you're seeing full exclusion. In some cases, you're seeing just the limited perils. So that's representative of what we're seeing. So with that, let's turn over to Monica, who's going to walk us through the historical context.
Thank you, Mike. To provide some context, silent cyber coverage has been a focus for UK regulators since July of 2017, when the Prudential Regulatory Authority, also known as the PRA, issued a supervisory statement regarding this issue. The term silent cyber is defined as any potential cyber exposure within the traditional property and liability insurance policy, which may not implicitly include or exclude cyber risk, but could theoretically pay claims for cyber losses in certain circumstances. So silent cyber is really all about the concern with ambiguity of coverage. Early in 2019, the PRA wrote to all CEOs of insurers, including the Lloyd's market, asking for action or an action plan to be put in place, providing clarity on how insurers intend to reduce the unintended exposure of non-affirmative cyber cover. The action plan was to be put in place on January 1st, 2020. The expectation for all of us was that insurers would develop approaches to pricing and capital setting for silent cyber risk. Lloyd's have taken a phased approach to the implementation of the silent cyber mandate. Phase 1, which covered first-party property damage policies, which were issued on or after January 1, was really the cause of most of our angst. New model clauses were issued by the London Market Association, also known as the LMA, in order to assist in implementing the requirements of the mandate. On the insurance company side, the International Underwriters Association, known as the IUA, also issued 2 distinct model cyber clauses. The UK regulators are certainly not alone in the effort to clarify cyber coverages in traditional lines. To highlight the importance of silent cyber risk, Fitch has also cited that failure to manage non-affirmative cyber exposures can be a rating criteria for insurers. So to sum it up, the aim of the regulatory mandate is threefold. 1, it is aimed to enable clients to have a clear understanding of the coverage provided by their policies. 2, cyber risks and accumulations are understood by all relevant stakeholders, that is, board of directors, underwriters, pricing and capital actuaries, and exposure analysts. And 3, risk is appropriately quantified on an expected basis for pricing, and the potential for those attritional and extreme events and accumulation is well understood. Next slide, please.
The challenge that we're having really with the mandate is that because of the timeline from Lloyd's and how the insurers have rushed to comply with the mandate itself, what we've seen is a trend towards exclusionary language being applied to the policies rather than affirming coverage for otherwise resulting loss. And that is what's sort of creating the gaps that we're starting to see. At the moment, the rationale for excluding is really the potential for systemic loss. And I think there's kind of 2 ways to think about what systemic loss means. On one hand, systemic loss could be one insurer who has a portfolio of lines of business that they provide cover on, and one cyber event causes them to see claims across their portfolio. Another way to think of systemic loss is one cyber event that sort of perpetuates across multiple entities in different industry segments, different for different reasons, and you have multiple clients all experiencing claims, and so insurers are seeing an aggregate loss potential there on one line of business, maybe cyber. But the reality is that we don't even have a good way to quantify the risk today, and that work hasn't really been done at this point. So there's no underwriting being done around the risk, and so the underwriters are kind of defaulting towards exclusions at this moment. The problem that we see with these exclusions is that they're kind of, some of the original exclusionary wording, like the CL380, for example, is very old. And so the world that we live in has changed quite a bit. The prevailing reality is that technology is integral to business across all sectors. So by excluding technology as either covered property or as recognizing that technology sort of underlines all of the work that we're doing today, we're ignoring the fact that it's integral to business as it's done. So to kind of deal with this problem, Marsh had convened a Silent Cyber Working Group about a year ago, and we were originally looking to just review the wordings that were being put out by insurers and make sure that they were not deeply limiting coverage for our clients, but also that they were compliant with the mandate. The scope and the work that we're doing as part of that Silent Cyber Working Group has changed and evolved over the past year. We are across the globe, so it's not just in the US or just in London, and we're working directly with various groups. So LMA, some of the committees in London and Lloyd's. We're working directly with insurers in the US, in London, in Europe, in the Nordic countries on the wordings that they are putting out and helping them to talk through these issues. We've spent a great deal of time educating insurers and educating clients as well about the potential gaps that these wordings are creating and encouraging insurers to go back to the drawing board. And at the same time, we're working with cyber insurers to come up with solutions that might help fill these gaps. So we're very deeply engaged and involved in the process. And I guess at this point, really the thing that we would say to all of you on the call today is that the challenge for you and for us is to really understand the potential impact that these proposed changes have to your policy wordings, and then to carefully consider how cyber loss or cyber events might impact you across various scenarios in the context of physical damage and business interruption. Next slide.
Rob, you want to come off mute?
Yep.
Thanks.
Thank you. That was a fantastic explanation of the history of how we've gotten to this point. And certainly from the regulator's perspective, what was their good intentions from their perspective, again, to try and get more clarity around cyber coverage or silent cyber as it relates to the property policies, has put us in a position right now where we find ourselves having more ambiguity. And on this slide here, we just highlight what has been the traditional approach leading up until this current position, really starting late 2019 and really accelerating now in 2020. And that has been the traditional approach under a property policy, where at a minimum, resulting damage from a cyber event would be insured with either a named perils basis or all risk of the type of perils that were insured in your property policy. Depending on the insurers, there would be certain levels of potential non-physical damage that could be granted within those policies. As we moved and see this new variety, and right now we're seeing typically about 8 different potential endorsements around these a way that cyber is potentially excluded in a property policy, it's creating a lot more contractual uncertainty with a lot more restrictions and in some cases, absolute exclusions about any type of resulting damage. And the key is to build awareness that this is developing. And based on that initial poll, we see it's evident from the audience today that for our large limit or large programs, there are a lot of non-concurrencies in different positions amongst insurers. How can we manage that? By building the awareness and identifying that where those endorsements and exclusions exist, and then working with our cyber team to understand where we can move specific coverage grants to a standalone cyber policy, and then for resulting damage to property, plant, and equipment, move into now what is a rapidly developing buyback market from the standalone cyber insurance.
Hey, Rob, sorry, I'm going to jump in because a question came in. Just feel like we should try to respond live. But the question is, we hear from our property insurers that the reinsurers are forcing coverage restrictions in treaty renewals to exclude cyber risks except resulting fire and explosion. Are we doing anything to educate reinsurers and reinsurance brokers to these broad brush measures that are inadvertently removing traditional physical damage cover from the market? Just any thoughts on that?
I can actually take that one, Rob.
Sure, go ahead, Elizabeth. Because
that's something that the Silent Cyber Working Group that we have at Marsh is heavily engaged in. So the Silent Cyber Working Group, as I mentioned, was cross-functional, so it's cross lines of business, but we're also including colleagues from Guy Carpenter that are in the reinsurance space. So we have been doing some of the same work with the reinsurers that we've been doing with the direct insurers in terms of education, reviewing the wordings, talking through the issues. And there are currently on the reinsurance side, from a property point of view, there are the exclusions kind of come in multiple flavors. And some of them do provide broad peril carve-backs. So what we've been trying to do is encourage the reinsurers not to limit any cover to just explosion or fire or something along those lines, and to not mandate that the direct insurers are including a specific wording in the policy. So if you're hearing that, if someone is telling you that they have no option because their reinsurers are requiring a certain exclusion, that may be not fully the whole story, but I think that the direct, the direct frontline underwriters are, that their own internal, I guess, working groups are telling them just, you have to have this exclusion on there. We are also working with reinsurers on things like pricing this risk and how to evaluate the overall exposure and help get a sense of what that systemic loss looks like. So there's a lot of work being done. It's not a perfect picture yet, though.
And Elizabeth, it's probably worth mentioning that that the Silent Cyber group that you work with includes Guy Carpenter, so certainly includes our reinsurance experts that are on board with the exact same endeavor. Yeah, perfect. So sorry, Rob, if we interrupted your flow there, but and I'll let you know too. Maybe you can weave this in while you're talking. But one of the advanced questions that came in, I think we'll start to fit in too. But the advanced question is, what is the best Lloyd's property policy cyber exclusion an insured could expect right now? So maybe if you can weave that into as you continue to work through this slide, that'd be great. Yeah. So and to answer that right away, the absolute best case we've seen has been an LMA 2914 and expanding the standard fire and explosion resulting damage to include machinery breakdown. We, depending on what point in the year, up until June, it was more common to get that. It's become increasingly difficult as the year has moved on to get that endorsement from underwriters, unless you have a significant amount of leverage, and that typically comes with a lower limit requirement. For the larger programs, it's becoming more difficult. We have seen underwriters in Lloyd's with a new LMA 5426 that's really geared for power and utility risks, but we're trying to push that out broadly to all energy and power and industrial risks that would give back fire and explosion plus mechanical breakdown, but it still follows the 5400 wording with a distinction for malicious versus non-malicious events. Great, Rob. And how about talking about the mutuals as well? So in the U.S., maybe give a little bit of commentary about what we're seeing from the mutuals in the U.S. as well as, I guess, OIL in outside of the U.S. too.
Correct. So OIL continues to be what we would say silent on the subject, on the topic. Moving into the Aegis wording, they have their own company version of a cyber exclusion that specifically grants resulting coverage with no limitation for any perils. It's a very contractually clear wording, which we think goes to that box that we have on the left-hand side here, the traditional policy. FM, verbally, they tell you they give full resulting damage in their policy. In their cyber event definition, the wording doesn't follow that exact verbal intent that they provide. In addition to the resulting damage to property, plant, and equipment, they have their non-physical damage coverage grants that we're seeing with lower sublimits than we've seen in the past, and that's a result of some claims activity over the years and pressure, they tell us, from their reinsurers.
Great.
Thank you. So we can move to the next slide, where we'd like to go over just some ideas around strategy. With all these different wordings, we know that this is one of many issues that you're going to manage with your property insurance renewals based on the current market conditions. But when you get these exclusions, the first step, reject those that you think are too onerous or that you can't live with. It's becoming increasingly difficult to do that if you're in a capacity constrained environment. Expect, from a geographic perspective, London and continental insurers to be using the most restrictive versions of these endorsements. We're seeing a break where US underwriters realizing that they need to be contractually certain, feeding into that second box, potentially giving more resulting perils than just fire and explosion. You need to be very specific with them about that request. You need to have a direct dialogue with them early, and you need to give them the time to start working through these potential internal approvals that they need to get going through the management chain. We are seeing some progress now compared to what we saw earlier in the summer. And once you move through that progression of trying to be very clear about the coverage that you expect, it's to have that direct dialogue during your underwriting presentations early in the process to tell them the expectations that you need the resulting damage insured in your property policy. It is the appropriate place for your property, plant, and equipment to be protected from resulting damage, and then work closely with your cyber team to maximize the specific coverage grants for non-physical damage and certain types of direct physical damage that they can achieve in that standalone marketplace. As the property policy comes to a conclusion, identify gaps that couldn't be resolved, and then have the property team work very closely with your cyber team on gap filling options, as again, we see that market becoming more and more robust. So as an analogy, the marine cargo teams used to work very closely with the property teams on stock throughputs, making sure that those policies would fit hand in glove. We now have that approach between our traditional property teams and our cyber teams on this topic to make sure that you can maximize the specific coverage grants, minimize these silent cyber gaps in the property market, so you have the best hand in glove solution for this coverage.
Excellent. Thanks, Rob. And maybe we'll, there's another question that came in advance. I think we'll pose to Elizabeth along these lines. But the question is, please discuss cyber caused property damage risk assessment and the relevance of the exposures versus new property exclusions. So I think, in other words, the question is getting at, are we seeing losses? And so discussing that risk assessment versus the exclusions. Could you comment on that, Elizabeth?
Yeah, I think that that's a really important question. And so I think it's touching on two things. I think it's touching on losses, but it's also touching on how do we get our arms around this. And from a losses perspective, while there are certainly a lot of cyber events going on, companies are getting hit by a lot of different malware. Ransomware is certainly on the increase both in frequency and severity of those claims. The resulting loss is typically non-damage business interruption. So no physical property has been damaged. There's been no resulting fire or physical peril to tangible property, with the exception of a few small anecdotes that we know of. There was a German foundry that had a fire. There's just not widespread evidence of property damage that's arising out of this. And I think some of the insurers have started to, we hear the words, cyber is a systemic loss issue. Cyber, it's a big concern because it's systemic, but several insurers who I've spoken with on the physical damage side have said, well, we don't think that the physical loss or damage scenario is what is the systemic risk. So from a loss perspective, I think the picture is more about non-damage or non-physical damage, traditional, what we would think of as traditional cyber that a cyber policy would address. And that's why it's really important too, to make sure that you've got both a property program and a traditional cyber program to get the full scope of claim. And the second part of that question about the, some of the assessments, I know FM, for example, and a couple other of the property carriers have now come out with their own kind of assessments on property controls that relate to cyber system security and those kinds of things. And some of the assessments that are done for the cyber insurers for traditional cyber, looking at cybersecurity, get to those same questions. And so it's a matter of, as Rob was saying, that hand in glove approach, that you're working with both your property underwriters, property broker and your cyber broker, and that those two teams are coordinating so that you're sharing information both on the front end and the back end. So you're in the marketplace for your program. If you have completed a cyber application, that application can be shared with the property underwriters as well, and that might help alleviate some of that strain.
Yeah, thanks, Elizabeth. I want to just highlight one of the things you said about systemic loss, because that's a really good point, I think. But if you think about it, in order to actually create physical damage with a hack, you have to have some sort of jumping into the industrial control system, there's an initial hack, there's the malware, but you actually have to be actively exploiting a particular hack. It's not one that's a widespread. It's one where the hacker is actively able to circumvent certain air gaps or get beyond them to get into those controls and actually affect physical damage, which seems to us to be an underwritable risk, that it's not a systemic risk, really.
Right.
Yeah,
and I think one of the challenges that the insurers have had is initially they've said, well, we have no way to evaluate what the exposure is here. We can't model it. We don't know how to look at cyber risk. Mm-hmm. But when you're thinking of a traditional line of business like property, they've already got models to evaluate what happens, how fire behaves, if there's a sprinkler leakage. It shouldn't matter if the trigger for that is something to do with data versus something to do with another physical object. So I think they're starting to think about it differently, and that's very encouraging.
Great. Thanks, Elizabeth. So with that, I think we'll transition to our next topic on cyber placement strategies. And to start off, let's have another polling question. Can we advance the slide? So this question is, does your organization currently buy a cyber policy? Every cyber webinar has this question, right? So let's get your responses. Answer yes, not yet, but considering no, or need more information. Wait a minute for the responses. And a good amount, 57%, currently do buy cyber, and 24% are seriously considering. So really a majority of this group does buy or are considering, which is interesting. So I think that reads in really well to our next topic, and we'll hand over to Sarah Baldes, who's going to talk about cyber insurance and strategies related to that.
Thanks, Mike. So within the context of this discussion, we thought it was important to level set on what a standalone cyber policy is and what it's intended to cover. And the next slide is a great illustration of how a cyber event can progress from the event occurrence itself to the immediate impacts on an organization, and then the potential resulting losses or claims that could arise. So cyber events, which can be either malicious or accidental, can lead to both non-physical and physical impacts, which are shown there in the middle row. Non-physical impacts are covered by the cyber policy, including issues with confidentiality, integrity, or availability, for example, encrypted data or privacy violations. However, the physical impacts are typically excluded by a cyber policy, and that would be property damage and bodily injury.
Sarah will interject with one of our advanced questions here because I think it fits right in. But so the question is, do you see bricking cover as a property market risk or a cyber risk?
Yeah, so that's a good question because bricking is sort of in the middle, at least conceptually, between cyber and property. And bricking means that a data storage device has been rendered inoperable by a cyber attack, but it's not actually physically damaged. So a really simple example would be a laptop that's been disabled by malware and can't be used again, but the laptop itself sustained no real physical damage. And this coverage is now on most cyber policies that we see, and it's more typically excluded on the property side because of that lack of physical damage. So the bottom row then on the slide shows the potential claims that could result from a cyber event. And while it would of course depend on the exact circumstances, most of the losses there on the bottom row would be covered by a standalone cyber policy. And the policy provides broad coverage for first and third party costs. So loss of income, fines and penalties, extortion demands, and negligence in services. But shareholder litigation, however, would not be covered by a cyber policy. We included D&O claims resulting from a cyber event are often a concern of clients and their boards, and we have seen D&O claim activity related to cyber. So on the next slide, we'll look at the coverages contained in a standalone cyber policy. So it's important to remember that cyber insurance was created to fill a gap between traditional property and casualty policies because data was determined to not be tangible property. So we look to cyber to provide that coverage. And the cyber insurance will cover first and third party liabilities and costs that could arise from a cyber event. On the left side of this slide, it shows the first party coverages, event management, breach response, business and network interruption, including extra expense and loss of business income, cyber extortion and ransomware, including ransom payments, and data restoration, which would be the cost to replace and restore damaged data or lost data. And then on the right side are the third-party coverages provided by a cyber policy. That would be privacy liability, including the failure to prevent disclosure of personally identifiable or confidential information. Network security liability. This means the failure of your network system to prevent or mitigate cyber attack and would pay for both liability and defense costs. And finally, the cyber policy also provides coverage for privacy regulatory defense costs. So it would respond to costs for fines and penalties assessed by regulators, and for utilities, this could be PCI, but also would include NERC or FERC fines or assessments from state regulators.
Sorry, I was on mute there. Thanks, Sarah. One question did come in, which I think fits in well here. And given that Caitlin has some personal experience, I'll ask this to Caitlin Upchurch. But the question is, can you provide some examples of contingent business interruption coverage related to suppliers and other third parties? Can you talk about CBI, Caitlin?
Yeah, sure, Mike. And good morning, everybody. So as I think one of the panelists previously mentioned, I think it was Elizabeth, it's important to think about the supply chain risk of your organization. So we are all reliant upon different types of technology to conduct our operations, and energy is no exception to that. So in one particular example that we had an energy company, a large energy company that was reliant upon a third-party data platform or data service to make decisions about some of their operations. And this is a very notable event that some of you may remember from 2018. There was a service provider in the energy sector providing technology services, data analytics to many of our energy customers. And that company experienced a cyber attack and they were shut down for a couple of days. So as a result, one of our energy customers was unable to complete a bidding process because they were not able to get certain information they needed to respond to sort of an RFP process. And just by default, that was a potential business interruption loss or potential future business interruption loss. I think we can find a number of different examples that could be similar to this, but generally speaking, just remember and to be thinking about the supply chain of your organization and how the dependence of technology that you may have just for your business may extend beyond just your corporate network and perhaps onto the networks of other third parties that you work with.
And Caitlin, I like your example too, because it shows that there was a cyber event, but it was a non-damage kind of, situation that could have potentially caused a lot of financial injury. And that's really what cyber insurance was created to address to begin with. And so it's helpful, I think, to always think about when you think about the prior slide, and then to think about how cyber insurance fits to your other portfolio of lines of cover, is to think of not just, do I have coverage for cyber, but think about, do I have coverage for downstream events, and then have specific causes of loss or specific loss examples in your mind when asking those questions.
Agreed.
Should we go to the next slide, Caitlin?
Sure. So of course, drum roll please. I know everybody is wondering about what is the solution, or what are the gap products that you can buy or consider in the cyber insurance market right now to address some of these gaps that we've been talking about during this discussion. And so the first comment is that there is no silver bullet for this. There's no single best solution for a company. It's really, number one, a fluid market for these solutions. And number two, it's very contingent upon what it is that your organization needs. And so as we've been talking about during this discussion today, it's absolutely critical for companies to take a step back and think about their risk, think about how a cyber event could unfold in their organization, and what types of resulting losses and expenses that the organization might incur as a result. But we know that all of you still want to understand what the solutions are in the market. And there are solutions in the market to buy back some of the property and exclusion wordings from a cyber perspective. So just to highlight a few, first I'll talk about BRIT for a minute. So BRIT is what I like to call a ground up solution. They have a product that provides up to 150 million of capacity. And it's essentially a traditional cyber insurance policy, but the main difference is that it has resulting property damage affirmative cover from a cyber event. And then it also has affirmative cover for resulting business interruption loss that's triggered from the physical damage that occurs from the cyber event. And that's kind of a complicated workflow to think about, but when you apply it out on paper and think through it for your organization, you can come up potentially with some examples of that. So BRIT is interested in companies in all sectors of the energy industry. We've worked with them on a number of deals. And again, this is a ground up solution, excess of a traditional self-insured retention. Another option, which is a little different, we've been working with Munich Re a lot. So Munich Re has a solution that is more of a buyback product. So while they do have the ability to write traditional cyber insurance ground up as part of this policy, really the essence of this Munich program is to pay a loss that would otherwise be paid under a property insurance policy, but for certain listed cyber exclusions such as LMA 5400. Munich Re has up to 275 million in capacity for this buyback. They are interested in the energy sector. They do have some capacity for power and utility. I know there was a question about that in the poll. And we have worked a lot with Munich Re, both Monica and I, as well as Mike Gaudet and some others in the practice, have been working with them a lot this year. And then finally, the third approach would be a DIC solution. And I know, talking to many of you, I'm not sure if you're on the phone today, the DIC is the more preferred route for you because it would be a last resort for filling in these gaps. And there are markets out there, including Aegis, AIG, and Chubb, that have DIC solutions available that were designed for this issue. This issue has since emerged and continued to emerge in the property markets. So we're staying in close connection with those carriers to understand their appetite. And then finally, just generally speaking, there are about 20 London markets that can provide capacity on a buyback basis.
Caitlin, thanks so much for that. So a question that came in advance fits in here. The question is, gap or affirmative cyber, where are we seeing demand from clients? How do we build cyber limits to match the property? So what I'm getting from that is that sense, like, are we seeing demand for these sort of gap solutions? How are we working through those? Maybe our experience with that.
Yeah, it's interesting because I would say the demand we're getting from customers vary. So in some cases, we have customers that come to us and they've really studied this issue. They've really worked with their property teams and or their cyber teams. And they've said, okay, we've identified what our risk is, we've identified what the potential loss is, and we know that we're concerned about filling this gap in this part of the property policy, and we want to fill the gap by buying 100 million of a gap solution. So that's probably the advanced end of the spectrum as far as a client's knowledge about this topic and what they want. And then we have clients on the complete opposite end of the spectrum, which are, they're just now grappling with the fact that they have these exclusions and they don't necessarily understand or appreciate the meaning of these exclusions. And so they're coming to Marsh for some education. And then we have clients in between that understand enough about it to know that it's potentially an issue. Perhaps they don't buy cyber insurance, but they're thinking about making a risk transfer investment this year, and they're trying to get some guidance as to whether or not they should focus their risk transfer dollars in a buyback solution or in a traditional cyber insurance solution. So that just tells us, you know, there's a lot of education that still needs to happen for our customers, which is exactly why we're hosting this event today. And then I think the second part of that question, Mike, was, can we build limits in the buyback market to replace the gaps in the property market? And yes, it is possible to do that. But again, I would encourage everybody to take away from this that thinking about what the loss scenario could be, how it would impact your organization. And to somebody's point earlier, I think Elizabeth, I mean, ransomware is rampant, and ransomware doesn't cause physical damage right now. Those are not the cases that we're seeing. Those are not the expenses that are getting paid. So it is possible that when you take a step back and think through your exposure, you may find that the physical damage aspect may not be the bigger driver of your risk and the bigger probability of a loss at the current moment.
Great. Well, maybe we'll wrap. Yeah. Sorry, Caitlin, go ahead.
Yeah. So the natural question I would have if I were you participating in this today is, where do I start? So I mentioned we have companies that are all across the spectrum as far as their decision point, where they're at with this issue. And in the cyber practice, we have this framework that we call understand, measure, manage. And I think it really applies very well to this scenario. As we've been discussing throughout this session today, the first step is to understand your risk. Understand your risk within a business perspective, but also understand your coverage too. So going back to Rob's point, very important to be working both with your cyber and your property teams to understand the coverage. And that process will drive what it is that we may want to place as far as the insurance product. The second part of the process would be to work and prepare a solid underwriting submission. So the underwriting submission can potentially serve two purposes. One, of course, it allows us to go into the market. And because you've done this understanding of what your risk is, you have a good way to articulate your risk and how you're mitigating that risk. So the submission can come in a number of different fashions. It can come from completing an application. It could come from doing a silence assessment if you're working with Aegis. Marsh also has a proprietary cyber self-assessment. And then also it's possible that in some cases we'd recommend that your CISO prepares a presentation to the board and then, or to the underwriters. And again, you know, we can take this information and use it as part of some leverage for negotiating these property exclusions. And then finally, the one thing I didn't mention kind of in the first step here as far as the analytics. So we'll have Toby talk about this here in just a second, but understanding what your exposure is, how an event could happen and what that event could cost is part of the best practice of evaluating your exposure to the risk. And there's some very in-depth ways to do that, which Toby will talk about, but there's also some very simple ways to do it as well. So with that, I think I'll turn it over back to you, Mike, or to Toby.
Yeah, thanks, Caitlin. Actually, so a question came in on Munich Re on the Q&A, and I think, Monica, do you want to respond to that? If you could just repeat the question, because I think it's disappeared from the Q&A, and just respond to that, that would be great.
I think the question was regarding the amount of capacity that Munich Re can deploy on a risk and whether or not you can split the capacity up between different layers and deploy it in a flexible manner. I guess it doesn't really matter if we're talking about Munich Re or another insurer in the London market, but specific to the Munich Re Stream Consortium, the consortium capacity of 275 million can only be deployed in one chunk and typically is deployed all together, if that makes sense. You cannot, I guess, separate the capacity because of the consortium members that participate on that. BRIT is the same, where they have the consortium of 150 million and can be deployed all in one chunk. However, if you access the Lloyd's market or Munich Re for their own capacity, so not including the consortium members, you could provide more flexibility around how they deploy their 50 million capacity on the property tower.
Great. Okay, if we could go to the next slide. Thanks for that, Monica. I think we're on a next polling question. So yeah, as we start to transition towards analytics and thinking about, how do we assess what our exposure is? How do we assess what our limit should be? Our polling question is whether or not you currently purchase a cyber policy, which factors would have the greatest impact on choosing coverage and limit? So is it broker recommendation, peer benchmarking, cyber risk severity modeling, or would it just clearly be just a board director decision? Recognizing it could be a combination of some of these, but if you could put down your first preference, that'd be appreciated. Let's see the responses. I'm actually not seeing the response. Can someone else see it? I don't know why it's not popping up on my screen.
Yeah, it's very interesting. Cyber risk severity modeling is 45%, and then the next big chunk is board of directors, but then broker recommendation and peer benchmarking kind of are a distant third. So yeah,
it's a perfect sort of, yeah, it goes right to our next section perfectly. So we'll hand off to Toby Hudson to walk us through how some of these analytics could be helpful in determining your limits.
Thanks, Mike. And good to see the results in the poll there, because makes my life a little bit easier, hopefully. As we're seeing, digitalization continues to be a force that is transforming the energy and power industry. It's making energy systems around the world more connected, intelligent, efficient, reliable, and sustainable. And this is driving the improvements in the safety, productivity, accessibility, and sustainability of such systems. However, as a result, the threat landscape and the nature of risk is changing. Risks are no longer discrete in nature, and they can challenge the traditional approaches as discussed with our earlier focus on property and cyber. A recent survey found that 71% of organizations said cyber attacks are still a bit of a black box, and that they struggle to understand how an attack would impact their organization beyond the obvious. So with that, there is a demand for a new approach to understand that beyond the obvious, one that takes an integrated risk measurement approach in order to account for the interconnected nature of an organization's risks today and in the future, that physical and non-physical, to support the resiliency challenge that organizations are faced with. So when we think about the cyber threats facing the energy and power companies today, they include those typical threats that plague other industries such as data theft, billing fraud, network interruption, system outages, and ransomware. However, when we consider the energy and power sector, several characteristics heighten the risk and impact of such threats. In particular, the unique interdependencies between the virtual systems and the physical infrastructure. At worst, consequences could include the loss of power, destruction of equipment, and damage to devices throughout the organization's value chain. For example, operators may rely on the accuracy of data to run critical OT environment and equipment with no manual validation or strong data integrity regimes. If this data is corrupted, tampered with, or made unavailable, this could result in the built-in safety controls not being triggered, causing that physical and non-physical damage. We can see regulatory fines and penalties, business interruption, and certainly some B2B, B2C impacts. Therefore, there's that need for the ability to view the collection of risk holistically, that the accounting, taking into account the interconnectedness of each, to ensure that the organization can fully contemplate its operational and strategic risks that threaten its firm value. Similarly, we need to capture this across the entire value chain to understand how these challenge key aspects such as your customer's trust, the system and technology platform reliability and robustness, and ultimately your balance sheet. So to this end, Marsh employs a scenario-based financial stress test to develop client unique models, which provide an empirical measurement of insurable and non-insurable risks in financial terms. And central to that analysis is really two questions. One, how can a technology failure, be it an internal or external one, create balance sheet volatility across your value chain, including those third and fourth parties? And then secondly, given that volatility, how can you most efficiently mitigate and transfer your risk? And so moving on, and so the outcome of using a scenario-based approach enables cyber to be viewed and measured through the lens of the business, allowing for the complexities of the impacts from such events to be captured, measured, and ultimately addressed through your risk transfer program to understand the residual risk that remains. For example, we had one client who was challenged to understand their complex and evolving risk exposure, particularly that connection between cyber and property across multiple sites and products, and how their insurance policies would respond following certain defined events. And the solution Marsh employed was to data scrape over 260 risk engineering reports and layer in additional client-specific data, such as their customer and third-party contractual exposures, to create a tailored, specific model. Really, this enabled the client to, first of all, understand the system risk and show the impact by legal entity, reportable segment, geography, and site, and by mechanical and electrical risk factors. And this was all conducted and showed through an integrative and digital dashboard so that the client is able to stress test multiple scenarios. Secondly, it was the ability to assess CapEx losses resulting from a cyber physical event and evaluate control efficacy over time. And thirdly, it really provided the exposure analysis that included frequency, severity, as well as estimated loss and volatility to those defined risk scenarios, such as system interruption. So overall, the client-specific model captured the organization's unique risk dynamics and relationships and the impact across its value chain, be it critical IT and OT systems, production, distribution, and its customers, using forward-looking models that are based on a 5-year time horizon, such that the client could evaluate potential future risks measured in net present value terms. And so really, the models therefore connect that risk to growth.
Thanks, Toby. And want to keep an eye on time. We're at 11:53 right now. Can we wrap up and maybe just talk about specifically how are analytics used to quantify physical damage for cyber risk, and also how can we use that to measure efficiency of risk transfer?
Yeah, and I think this is where we can really deliver some value to our clients and prospects, as the approach enables us to leverage the expertise across multiple areas of the business throughout Marsh. And there are really three key steps that we would undertake to help think through client concerns and prospects in this area. Firstly is let's define the risk scenarios. What are the organization's greatest concerns, that hierarchy of badness, and what unique components are there specific to the organization? And then secondly, let's quantify the risk, provide an advanced understanding of both the insurable and non-insurable risks, that estimated gross loss, that takes into account the elements of control built in within the organization to determine the estimated cost and volatility from such events. And then lastly is that optimization piece that you mentioned, Mike, around the risk transfer strategy. So this really involves our wording expertise to conduct insurance gap analysis across multiple programs, such as property, cyber, and D&O, as well as determining what the most efficient limit and retention is based on the organization's risk and exposure, and to provide a measurement of that risk capital return on investment.
Excellent. Thanks, Toby. So I think we'll wrap up with like a recap on the best practices noted. And Elizabeth, you want to take us through some of these key points?
Yeah, sure. So, I mean, I think that the main thing is to know that we hear you and your concerns, and we're doing what we can to move the markets with our Silent Cyber initiative, but also as you provide feedback during your placement process, that helps to move the markets as well. So continue to do that. And if you don't like what you're hearing when you get quotes or what coverage is being excluded, push back on that, because I think that until insurers really understand and hear that broadly, there's not going to be a lot of change. We talked today a bit about needing cross-functional strategies, both in property and cyber, to alleviate the pressure on these gaps and to kind of fill those gaps. And I think that will continue. So make sure that you're engaging both your property and your cyber resources to help work through these issues. And then prioritization is just so important. So you want to really think about your property capacity and where you're getting it from. And a lot of the energy mutual insurers do affirmatively cover ensuing damage. That's very important. That can alleviate the gaps that are created by markets that are being more express in excluding ensuing loss. And then try to identify the Lloyd's markets that are giving you more favorable wording, and see if you can prioritize which markets are on your tower to give you the best coverage up front. And then be willing to think about alternative approaches. And then when you're thinking about how to set yourself ahead of your peers or above your peers, it's really important that your submission includes as much as possible in terms of details on the maturity of your cybersecurity controls. So that's where working hand in glove with your cyber broking colleagues or resources can help you, because they can use the information that's provided to the cyber insurers to help the property underwriters get their arms around the exposures. And then prioritize what is important to you. Is it coverage or is it exposure that you're most concerned about? And do you need non-physical loss cyber coverage more than you need physical loss or damage cover, or is it vice versa? Having that sort of in your own head to think about as you're approaching the market will serve you well when you're budgeting and figuring out how to spend your money effectively. And to the extent that you're able to quantify your exposure by using your own internal methodologies for doing that, or working with Marsh or other consultants on some of the projects, the analysis that Toby was talking about, I think is very useful. And then really think about what is the most efficient risk transfer for you. And so you're able to take control back and not be subject so much to the whims of the marketplace.
Excellent. Thanks so much, Elizabeth. We have approached the end of the hour, and fortunately, we actually have cleared out all the questions that have come in. So I want to take this opportunity to thank all of our panelists and their time and expertise, as well as all of you for joining us today. We know this is a time commitment. We really appreciate having you here for the discussion. We'll send out a replay of this webcast for the next couple of days. Slides will also be available to be dispersed. If you have any additional questions, please reach out to any of us anytime. You can also stay current on our thought leadership offerings, either on marsh.com or on LinkedIn or Marsh Global on Twitter. We really appreciate ongoing interaction with you all. And again, thank you all for joining us, and have a great afternoon.